Welcome back to today's Explainer. It's May 3rd, 2026. And look, if you've been watching the charts, you know things are really heating up. But what you're seeing right now on the surface, that's barely even a fraction of the real story. Today, we're diving deep beneath the flashy crypto headlines to uncover the massive social and machine structural shifts that are actually driving this market.
Let's kick things off with a pretty crucial question. Bitcoin is currently flirting with the $78,000 mark. But who, or actually, scratch that, what is really driving this momentum? While human retail traders are generating a ton of that surface-level volume right now, I'm going to show you why the next major market event is almost certainly going to be driven by machines, algorithms, and some pretty severe systemic security threats.
Okay, let's jump into Section 1, Surface Level, Prices, and Social.
So, $78,000, it's a massive psychological level for Bitcoin. But to really grasp what's happening, we have to zoom out and look at the macro catalysts. Now, the Fed holding rates steady and some recent minor sell-offs have basically been acting as a lid, keeping a larger breakout in check. But at the exact same time, we've got some heavy global events providing massive upward pressure.
We're seeing a wild convergence of geopolitical events lifting prices across the board. Tensions seem to be easing. Iran just declared the Strait of Hormuz completely open, and we've got statements from Trump indicating Iran agreed to suspend its nuclear program. Add all of that to a broader risk-on mood in traditional equities that just pushed the S&P 500 to a record high, and well, you get the highly visible surface-level rally we're witnessing today.
But right alongside that price action, we have this absolutely staggering number: $1 billion. That is the estimated global trading volume on X's brand new Smart Cashtags feature, and that's just days after it launched.
This right here? This is the social half of our new market reality. Retail traders are completely bypassing traditional exchanges. They are buying major assets like Bitcoin, Ethereum, XRP, and Doge directly through social platforms. It's literally turning the real-time news cycle and social FOMO into a primary driver of market liquidity.
Which brings us to Section 2, the rise of AI agents.
If you want to understand where the market is actually heading, you absolutely have to wrap your head around the Agentic Web. This is a newly evolving financial infrastructure where AI agents operate completely autonomously. They're executing trades, hunting for yield, and managing liquidity at machine speeds. We are rapidly moving from a market of millions of humans to a market of billions of bots. And the most important takeaway? Bots don't feel fear or FOMO. They trade strictly on algorithmic efficiency. Just to put the sheer scale of this into perspective, we're looking at a $28 trillion agent economy. Trillion with a T. And get this, 76% of that is just bots shuffling stablecoins around. It's basically algorithmic plumbing happening behind the scenes 24/7 without a single human finger ever clicking a mouse. We are literally watching blockchains redesign their entire architecture specifically for these machines. While us humans are still struggling with fragmented liquidity and clunky, slow interfaces, networks are adapting. Take TRON's recent integration with deBridge's MCP server. It creates a unified execution layer. It completely eliminates cross-chain friction so AI agents can move assets instantly, zero human intervention required.
All right, let's go deeper into Section 3, Institutional Capital Moves On-Chain.
TradFi integration isn't just coming anymore, it is accelerating rapidly. We're seeing major retail access open up, like Charles Schwab rolling out spot trading and Crypto.com launching digital native IRAs specifically designed for the retirement market. And on a global scale, Singapore Gulf Bank just launched direct USDC minting on Solana, and Ripple is pioneering sovereign debt settlement in South Korea.
But let's take a quick reality check here to ground the hype, straight from Paris Blockchain Week. Take Flow Capital, for example. They're planning to tokenize a massive $150 million private credit fund via the DigiFT platform. But tokenization doesn't magically fix illiquidity. If there's no active secondary market to actually trade that digital credit, it remains just as illiquid as it was on a piece of paper.
Plus, institutional adoption is, frankly, incredibly complex. While Ripple successfully pioneered those tokenized bonds in Korea, their dollar stablecoin RLUSD is hitting a massive wall right now with Japanese megabanks. Even in a historically XRP-friendly market like Japan, institutional trust is way harder to engineer than a smart contract.
Now for the darkest part of the iceberg. Section 4, Hidden Threats, Hacks, and Insiders.
The scale of insider risk in this industry right now is, well, it's absolutely terrifying.
Recent findings from the Ketman project, which, by the way, was funded by an Ethereum Foundation stipend, exposed 100 North Korean operatives who have successfully infiltrated dozens of crypto projects. We're talking about state-sponsored threat actors sitting right at the foundation of our protocols, writing the code that secures billions of dollars. The big question is whether the broader market can actually absorb this level of insider risk without a full-blown panic.
And when those vulnerabilities actually get exploited, whether by insiders or external attackers, the damage is catastrophic. Just look at the recent $270 million exploit of the Drift protocol. It required a massive, centralized intervention, specifically a $127.5 million rescue commitment from Tether, just to keep the ecosystem afloat. It really highlights this terrifying fragility lingering right beneath the decentralized surface.
And at the exact same time, the industry's human defense layer is thinning out. We're seeing a major talent drain from top-tier crypto firms over to leading AI startups. A prime example? Base's marketing lead, Sarah Wolf, leaving Coinbase to head up marketing at the AI heavyweight Anthropic. Human capital is rapidly shifting toward AI infrastructure.
Now, why does a talent shift matter to the market? Because of hyper-advanced tools like Anthropic's Mythos AI. Security leaders are warning that the next major volatility event won't be a price swing. It's going to be a systemic security shock. These AI agents can hunt down DeFi vulnerabilities so fast that we could see irreversible protocol drains before a human developer could even type a single line of code to stop it.
And this has escalated far beyond just being a crypto problem. The US Fed and Treasury are now officially warning banks that Anthropic-class AI poses a live, systemic cyber threat to global financial infrastructure. And speaking of systemic risks, Telegram CEO Pavel Durov just issued a stark public warning about new EU age verification apps reportedly getting compromised within minutes of launch. All of this is driving a massive institutional need for privacy-preserving networks like VerifiedX.
So, as we wrap up today's explainer, I want you to look past the social media FOMO. If the market can somehow weather these systemic AI and North Korean insider threats from the Ketman project, this current consolidation phase could easily lead to a mid-May push toward $85,000. Keep a close watch for breakouts in real-world asset tokens, like OND and XLM, as this institutional shift plays out. I leave you with this final thought. As capital and execution move entirely over to algorithms, are you actually ready for machine speed volatility? Keep your eyes beneath the surface.